We're going to go through 4 different sections of the webinar today, as has been our habit recently. The first part is going to be the economic summary, and at this point, I don't think too many of you will be surprised. The headline is Strong Fundamentals. I'll review those briefly. I'm going to remind everybody what our key themes are for 2024. This is something we began doing about 3 years ago, where we come up with a set of key themes that we're going to reinforce and explain as we go through that year. We're going to do a market recap, and once again, it is U.S.-led progress in the markets. We're going to wrap up with what I think might be the most interesting part of the presentation. That's the market outlook. And I just have to let you know, for years and years and years, I have threatened to do a deep dive into inflation and all the different ways that economists like to slice up that bit of data. And by the end of it, we'll all be inflation geeks. So if you're having a conversation with a friend or a neighbor and somebody brings up the topic of inflation, boy, how about inflation these days? You will be well armed to discuss that topic. I was just sure as I began putting this together that I was going to have a quarterly market report where I did not spend a lot of time talking about artificial intelligence. That turned out to not be the case. And as I'm doing the research on inflation, I realized that a bit to my surprise, and I'm sure to the surprise of some others on the webinar, inflation and artificial intelligence really have a direct linkage, and I think it's going to be very interesting when we get into that topic. But let's go ahead and launch here, and we're going to do a brief economic summary. We're going to go through fundamentals, just review a few things real quick, and let's start with talking about employment. Employment and the strength of the employment market has really been the backbone for my contention that we're not going to have a recession for really the last 3 years now. But I wanted to show some data that's different from what we've normally shown. In this graph here, I think it explains it best. If we just graph the number of available workers and the number of available jobs, you'll understand just how strong the labor market has been and just how strong the economy has been. We don't have to parse out percentages and all these different things like the official numbers often do. What you can see here is that the number of available jobs has continued to rise as the economy has grown. You see it leveling off a little bit as efficiencies are picking up. The number of available workers is still chasing those jobs. Now, if you look at that data there for the most recent history and say, oops, the number of workers is about to catch the number of jobs, just understand that we through most of our history, have more workers than jobs. It's a bit unusual to have this many more jobs than workers, but that's where we're at. So if you just drew some lines through the most recent trends, you might suspect that we've got another year or two to go where we still have jobs just left open because the people just do not exist in the labor force. And so both numbers have been growing, and that's one of the reasons I've been so confident about the economy for the last 3 years. There's a hidden bit of analysis there that nobody else seems to be covering in all this employment data. It's there on the Bureau of Labor Statistics.gov website, but I just haven't heard any of the politicians try to take credit for this yet. Perhaps it's easier to stoke fear than show progress sometimes. But one of the outcomes of a strong labor market, and we've seen this for decades and decades when the economy gets really strong, regardless of who's in the White House and who's in Congress, is that the rising tide does lift all boats. Right now, we are seeing the major racial groups, as is tracked by the Bureau of Labor Statistics and is often discussed by politicians, converge on an unemployment rate that's just about the same for every major group. Now, it's not unusual for there to be differences, but the differences are about as small as I've ever seen them. So there again is always the trend in a strong labor market for them to come together, but there are fewer differences in that unemployment rate than we've seen certainly in decades. So I guess, a testament to just how strong the labor market has been and how the experience and benefit of that has been fairly widespread across the country. A common piece of data to be shown to you by economists when the strength of the economy is being discussed is gross domestic product. Some of you may have learned over the last few quarters when I show this data is that you'll get a GDP print, and we know it's wrong, and then we get the correction, and we know that's wrong, and then we get the final correction, and we hope that that's right. Yet all along the way, every week, there is a print of the weekly economic index. And even though there's a little bit of noise in that, it turns out to be amazingly accurate with the long-term twice corrected data for GDP. And so what you see with the weekly economic index in blue is that we're kind of settling into about a 2% rate of growth. And that's real growth. That means over and above the rate of inflation. So if the rate of inflation, and we won't get into which rate we're talking about here just yet, is 3, if the real rate is 2, that means the gross rate of economic growth is 5% a year. So we're really concerned about this metric after adjusting down for inflation. So we subtract the inflation rate out of that. So 2% pretty steady is actually pretty good. We're not going to be surprised if that begins to tick up. We've been predicting that, in fact, but it's very healthy. And just think the gross number is more like 5, but take out the inflation, we're growing at about 2, which is terrific and a very good number considering that we don't have enough workers in many industries to grow as fast as we'd like. And so just to wrap up the economic strength pitch here, a lot of you have become accustomed to seeing this metric here that's in red. That is the Federal Reserve's probability that we're going to have a recession in the foreseeable future. And it's amazingly accurate. I don't hear anybody else talking about it for whatever reason. But as you can see, as you go back through time, that probability of a recession tends to rise well before the actual recession starts. And the actual recession starts when you see the gray bars there. The one exception was the pandemic because it came on so quick. The green line, by the way, is the weekly return of the U.S. stock market. You'll just note that sometimes it goes down when there's not a recession, and sometimes it'll even go up towards the end of a recession. The real takeaway there is the red bar, of course. And right now, the Federal Reserve's latest estimate is that we have less than a 1% chance of a recession in the foreseeable future. So that was always the backstop to my analysis, and it's turned out to be very, very accurate. So once again, I don't think there's a recession in our future. So with all that good news, how has the market reacted? Because markets in the economy are not always linked in the short run. They are in the long run, but not necessarily in the short run. Well, they do seem to be linked right now. For the first 3 months of 2024, the global equity index, the index of 12,000 plus stocks all around the world, is up 7.72%. Again, that's just for the first quarter. For the last 12 months, ended at the end of March, that's 22.45%. Now, I'll show you in a minute that the U.S. has done even better than that, and I'm happy that we overweight the U.S. But in 1 year, that's 22.45%. And when we look at our long-term estimates, we expect about 9% a year. So about 2.5 years worth of stock market return in the last one kind of makes up for the big dip that we had about a year ago. So our 3-year numbers at 6.31, our 5-year number 10.57, and our 10-year number about 8.5. So just what we hope to see. At the top of that table, you see some numbers that look pretty discouraging for the Bloomberg Aggregate U.S. Fixed Income Index. The good news for our clients is that I think on the whole, almost without exception, you've done significantly better than that because we shifted our strategy to be nowhere close to indexing a number of years ago. And so just as a ballpark, if you looked at the last 3 years of the index at about -2.5, I imagine most of our clients beat that by 4 or 5% a year. Individual circumstances are different, but we moved to floating rate bonds almost exclusively, government bonds for safety, and we just haven't had to suffer the price declines that we saw starting 2 years ago when the Federal Reserve finally began raising interest rates. That's what killed the index, but not our investment strategy. So having shown you the strength of the economy and how that's manifested in the markets, let me just remind you real quick, what are our key themes for 2024? If you attended last quarter, this is not a surprise. This is the exact same list. We've got all this strength in the economy, but we're worried about how the markets could react if the domestic political crisis, and I'm using the word crisis, gets worse. I think divisions within the U.S. just continue to widen. Always worried about geopolitical shocks. For the moment, we're not thinking China is about to invade Taiwan, but there's certainly huge amounts of stress in the Middle East, huge amounts of stress in Ukraine, and everything could get worse very, very quickly. In fact, I think those first two items are linked. If I'll call it the social crisis, the political crisis in the U.S. gets worse, I think we're more vulnerable to our enemies, and so that could be a good time for enemies of the United States to attack us or make moves that they think we might not have the will to respond to. So I hope that we don't experience either of those in 2024, but it is a reason to be a little cautious despite how well our economy is doing. I'm always worried about volatility among individual stocks, but with the artificial intelligence boom well underway, we are going to see some companies be winners and some companies be outcompeted in dramatic fashion. It has already become common this year to see a market that is moving up, but a large, widely held stock be down 10%, 15% in a day, in many cases, because they are in a field where artificial intelligence is becoming a more critical resource, and perhaps they're not competing as well as they could. The last item here is the private market revolution. We're actually not going to spend a lot of time on that today. We have in other quarterly market reports. It's not just about it being a great market to invest in, a good time to invest in it, but also the new ways to invest with much more flexible vehicles. But I'm sure we'll circle back on that later in the year. One more slide I threw in here really for you to have as a takeaway, and we'll send you a copy of this presentation and you'll be able to watch it on YouTube here in a few more days. This is an article written by Dimensional Fund Advisors. They're a mutual fund ETF shop. And they just reminded us with this article about BlackBerry, which is kind of a meme stock now. It bounces around, but how you can have a stock and make the case about how it's just the best company, the best business model, and the best market, and how could anything ever go wrong? And then all of a sudden, it's just not competitive anymore. This pace of technological innovation can catch anybody, any company that is out of step just a little bit, in such a way that the enterprise more or less falls apart. And so it's an interesting chart because we can see the iPhone coming out and Android coming out and all these things happening, and yet the stock continues to go up, giving comfort to people that were just sure BlackBerry would last forever until it peaks and then just falls off a cliff. So I'm going to ignore the meme stock trading that's going on right now. I think that's just a distraction. Again, the lesson is no stock is safe from being overtaken by superior competition. We'll move kind of quickly through this next section. If you were with us 6 months ago when you saw the quarterly market report with the headline American Exceptionalism, then you won't be surprised to hear some of the things I'm about to say. But once again, U.S. led the way. And if we look at a timeline of events for the first quarter, what you'll see in that timeline is that we had one of the smoothest quarters ever. The market just continued to move up regardless of the headlines. I didn't even bother to go in and put some of the headlines in green and some of the headlines in red, what was good, what was bad, what was moving the market around. It didn't matter. Everything just continued to move up. What's really interesting, again, in looking at the smoothness of the market returns, this is the global equity index in the first quarter, was this idea that there were many individual stocks being absolutely battered. And yet, if you were diversified and didn't catch those headlines, you wouldn't have noticed, because a diversified investor enjoyed a very smooth ride upwards. As we begin to break things down into their constituent parts, you get this idea of the US-led progress there. When you see that the US stock market was up about 10%, and that really dwarfed the returns from any other part of the stock market. And of course, the fixed income index was very mixed, but our clients did much better. So when we dive into the US stock market in the next slide here, what you'll see is that growth stocks led. But here's the real news for me. You'll recall that I've said on several occasions that we overweight the US. What you'll see on the slide here is that the US keeps taking on a bigger and bigger part, a bigger percentage of the global stock market. A year ago, the US was 59% of the value of the global stock market. If you go buy that Vanguard ETF that owns all 12,000 plus stocks around the globe, 63% of that is US based now. So when we change our targets for how we invest, which we do on a regular basis, the most common adjustment we're having to make for the stock market allocations is to continue to put more and more of that in the US to try to stay at least a little bit ahead of this outperforming US market. When we look at international developed market stocks, it was still all good news, but just not to such a degree. But that's a little bit misleading. We show the progress of the international developed markets in two ways. We have the light gray bar, which is what those markets actually did in their own currency. And then you have the dark gray bar, which is unfortunately what we got. But that's a function of the US dollar increasing in strength, meaning that the foreign currencies were weaker. And so when you invest overseas, you're really investing in the foreign currency and the markets. And when those currencies go down, your return gets clipped. And so that's why we got the lower returns, the ones in dark gray. But also keep this in mind, a strengthening US dollar is deflationary for all of us. If you walk down the aisles of Walmart or Home Depot or Target or Lowe's or you name it, an awful lot of what you're buying was made in China. And so a stronger dollar means we can buy more of those things. So we can now expect the prices of those to begin to drop. So a stronger dollar is deflationary. We see exactly the same trend in emerging markets. More than 3/4 of the world's population lives in that 10% of countries that, or the 10% of the market cap in those countries. So we know there's enormous potential for the future. Not the worst quarter ever. The long term, at least over the last decade, if you call that long term, has not been so great. So we're looking for the time when maybe there's a chance to not underweight emerging markets. Maybe there will at some point in the future be a chance to overweight, but we don't see that as being right around the corner. And then lastly, fixed income. So everybody's making money in fixed income if they're just being super safe. We can do better than cash by being in 3-month US Treasuries, and we have a number of ways to do that, and that's been our dominant strategy for the last 3 years. That's why we've got that listed in green below. If you're out there buying long-term bonds, you've been punished, and of course we have not been doing that. So there's a lot of different ways to describe the fixed income market. Again, the one in green has been our dominant strategy. We have an entire strategy called short-term tactical built around that, but it's a big part of how we invest fixed income, even for what we'll call our primary portfolio strategy. So we're very happy that that has been our theme, and we have just dodged the volatility that you would get if you just indexed this. One other quick point to make about this chart. When you look at the middle top section there, what we call the US Treasury yield curve, you'll notice that short-term rates seem higher than the rates from, say, 1.5 years out. Well, the Federal Reserve sets the short-term rate and the market sets all the other rates. And this is one more reason why I'm going to tell you that I think interest rates are going to come down some this year, despite some of the worries that you might have heard about inflation. The market has already said that the short-term rate is too high. Whenever you see a kink in the line like you do right now, whether you're talking about munis or, you can see the light blue where we were at 3 months ago and the dark blue where we're at now. When you see that kink on the short end, the market already knows what the Fed's going to have to do, and it even tells you the timing of when it's going to do it. So short-term interest rates are too high. They're going to need to bring them down. And the bond market has already sussed out some of what I'm about to tell you about inflation. So let's jump into inflation, and then at the end, we'll bring artificial intelligence into that. I want to show you a slide of commodity prices and their changes just in the first quarter. And I show this because I think this is probably how most of us experience inflation. We go to the gas pump every week or two or three, unless we're only driving an electric vehicle, but then, we're probably paying for fuel of some sort to electrify our home and charge those vehicles. One way or another, we're experiencing the volatility that comes with the price of natural gas, the price of gas at the pump, crude oil, so on. These commodities, however, are not the whole story, and these commodities are the most volatile members of what is nearly 200 different types of things that we all buy that constitute the consumer price index. And so this is what we feel, but it's really not the whole story, and maybe not the best way to think about inflation. It's what we see, it's what we talk about, but there's more data to consider. So if we look at the 178 data points that make up the CPI, the Consumer Price Index, and then we come in and we say, well, which ones are food and energy? Let's put those in red, and everything else we'll put in blue, and then let's rank them all by volatility. The average change that we see quarter to quarter, month to month, what we see is that, wow, a lot of the food and energy items are the most volatile. Now, that doesn't mean they go up the most. It doesn't mean they go down the most, just that they bounce around the most. And so if you're just looking at those commodity items, which tend to be a lot of the food and energy, you get very different readings month to month, quarter to quarter. They're just so volatile. So it's very, very noisy. So again, you can take the CPI and divide it up. You can say, let's just look at the core items, or let's look at everything. And in fact, you'll often get CPI in those two different versions, and they'll tell different stories. So here's a graph of the consumer price index. And if you just want to look at that total measure, that's in red, and that includes all 178 items. But if you strip out the food and energy, that's the blue, you see that it's not nearly as volatile. Now, in the long run, the results turn out to be virtually identical. And so the long run is at least a few years. So if you don't want to be caught up in the volatility month to month, since it always evens out, you can just ignore those items and look at the blue and get a pretty good measure of a less volatile inflation that's more likely to represent where we're at right now, or at least how it's going to even out, the next time the food and energy that went up then goes down, or vice versa. So that's the difference in the long term of how those look. Now, that's a pretty good measure. We're going to call that headline inflation and then core headline inflation. But it turns out that there is a different measure for CPI out there, and you don't hear about it much. But hey, if we're going to put on our geek hats and learn about inflation, we got to include this, because it affects the taxes that you pay in a major way. Buried in some of the details of the change to our personal income tax rates that happened in 2017 is an adjustment that says we're no longer going to move the tax brackets up each year based on CPI. We're going to move it up based on chained CPI. And here's the short version for what that means. Change CPI recognizes the fact that you and I as consumers, when faced with rising prices in some items, presumably food would be one of those items that's, most volatile, we're going to make substitutes. And what I remember being taught in the freshman economics class was, if the price of butter goes up, we buy more margarine. Now, that might not actually be true anymore. Not a lot of us buy margarine the way we used to, but those are examples of substitutes, and there's thousands of substitutes out there. The idea is that as consumers, we're responsive to price changes. The demand for any particular good is not completely inelastic. When the price of something goes up, we'll switch what we buy. And so change CPI incorporates some of that switching. And so the rate of change CPI inflation is just less. And so what that means is that over time, your tax brackets are not going to shift up as much as they might otherwise. You could call it a tax increase, or your taxes just aren't going to get cut as much. But over a 10-year period, that can really matter. And that's the reason that that was part of the 2017 tax decrease bill, is they're just not going to decrease over time quite as much as you might have thought they would. Now, we've just beaten CPI to death. You've learned everything about CPI, just about that there is to learn. There's another measure of CPI that is used for how Social Security cost of living adjustment happens, but we don't have to get into that right now. We'll put some limits here. And what I'm going to tell you now is that if you ever read anything that comes out of the Federal Reserve, they're not even going to talk about CPI. They reject the whole CPI measure, and instead they look at what they call PCE, which is personal consumption expenditures. And so that's even different from CPI and different from change CPI. It is less volatile. It does tend to be just a little bit lower. And so when you hear that the Federal Reserve has this arbitrary target of 2% inflation, they're talking about PCE, not CPI. And again, historically, PCE is a little bit lower. So if the Fed wants PCE to be at 2%, convert that to CPI and estimate maybe that's CPI of 2.25%. And so even when you're looking at PCE, there's this idea that the volatility of food and energy can ruin that measure on a month-to-month, quarter-to-quarter basis, because it's so volatile, it'll drag it in different directions. And so they'll do a core PCE, and that's what you see in red here. But actually, I'll give the Fed some credit for this one. They do that a little bit better. You might remember back on that table that you had some food and energy items that weren't that volatile. So actually, the Fed says, look, let's just trim the most volatile stuff out of there, whether it's food and energy or not. And that's what they call trimmed mean PCE. So the next time the Fed has a release, and you want to go read those minutes, go through all those notes, you can find it on CNBC and some other places. Go look for the words trimmed mean PCE inflation. And again, that's PCE, not CPI. They get rid of the most volatile stuff, whether it's food and energy or not. And that's what they're really focused on. And that's what they really want to see be around 2%. So it's harder data to get on your own. But now we're all experts on inflation. So now let me get away from the definitions and get conceptual for a minute. When we buy things in this country now, despite our consumer economy, we're very likely to be buying services, maybe more services than goods for some of us. So when we think of inflation, we think of things we buy that we can hold in our hand, but the reality is far different from that. And I'm going to predict that in the future, and even this year, you're going to begin to hear a lot more about the difference in goods inflation and services inflation. And so in this chart here, services inflation is in blue, and services have been getting more expensive. You see the volatility of the goods inflation there in orange, but at least of late, a lot of goods have been getting cheaper. Energy prices have been coming down and other things have been getting cheaper. We're sort of putting some of that inflation behind us. yet services have been getting more expensive. So what you see is they don't really move in sync. And what I'm going to predict is that they're going to continue to move out of sync. And we're all going to have to learn about services versus goods inflation. The problem for the Federal Reserve is they just have a very limited toolkit. They can raise overnight rates, lower overnight rates, and they're going to have an impact on both. So if they begin to go in different directions, they're really going to be in a pickle as to what to do to manage that. So here's a good example of the differences. And, we each have our own personal inflation rate. But look at the differences. At the bottom, that's flat screen TVs, and they have been getting cheaper and cheaper. And, I'm making some assumptions about what demographic each of us might belong in. But, our demographic can be a pretty good predictor of whether we're buying things that are going up in price or buying things that are going down in price. So a few weeks ago, I was at a friend's house, and he had the same 42-inch TV that we were watching, that I remember watching the last time I'd been at his house 3 or 4 years ago, and he just hadn't bought a new one yet. And I was teasing him just a little bit and said, how much do you think an 85-inch 4K TV from Costco would be if you bought their least expensive one right now? And a few of us around the room tried to hazard a guess, but you can go buy a 4K 85-inch flat screen TV from Costco, and maybe from some other places as well right now, for less than $750. The price of TVs continues to plummet. So if that's one of your bigger expenditures, then that's actually gotten cheaper. There's a few other things in there that might be bought more by younger people, or at least it's a bigger part of their budget, that have deflated. Now, young families are buying new cars and, houses and so on. And some of those things have been stable at best or going up in price. If you're buying a college education, we put college students here, maybe it's the parents paying for it, unless it's the college students taking out the loans to pay for it. But college education has just suffered from runaway inflation for decades. There is probably no industry more ripe for disruption by AI than education. But it hasn't happened yet. And if you look at what a college education costs, it's, when inflation was running at 2, college education price increases were running at 6. So it's definitely inflated over the last few decades at a much higher rate. This chart is 2000 to 2022. And if you think college inflation has been high, what about healthcare? And seniors tend to spend more on healthcare than any other demographic. And hospital services and diagnostics and all these things have become significantly more expensive. It actually dwarfs the inflation rate that we've seen in healthcare. And once again, this is ripe for disruption. Now, these are services. So what's been happening is services have been getting more expensive. But let's just talk for a minute about what AI does. AI is one of these things that is changing the world through technology, but it's doing it in a way that has got some similarities and lessons from the past, but in some ways is different. You may recognize this little screenshot here of Sandra Bullock looking at a website called pizza.net, and that's straight out of the 1995 movie The Net. But let me talk about that website for a minute, talk about AI, and draw on some lessons from the past. So we know AI is going to change the world. Let's imagine for a minute that we are just 2 or 3 years in the future. Here's what I think is going to happen. I think most of us are going to wake up and be talking to our own AI. Our AI may tell us about our schedule for the day, some things that we might want to change about our schedule because of our priorities that we have discussed with our AI agent. If you're getting ready for work, it might try to make sure that you're on time, might begin preparing you for issues you're going to face when you start working. Your AI, I think, will follow you from your personal life directly into your work life. If you're in a position of management responsibility for a company. I think your AI will help you to figure out your day and what other people are doing that you have a responsibility for, perhaps as a manager who's begun work, who hasn't, if something's going wrong, if something needs your immediate attention. And so think of AI not just in that broad scenario I just described, but think of AI in a medical setting. Think of AI helping doctors to diagnose MRI scans and do other things like that. I mean, that's already happening today, and the accuracy rates for AI are being reported in many stories as being significantly better than a human can do. But it's not just that it's better, that it's more accurate, it's also much, much faster. So if you're getting any kind of scan today, it's very common, whether it's radiology or something more sophisticated than that, that there might have been some sort of computer technology, even AI, helping to read that to give the doctor the most accurate result. Well, that's faster, that's cheaper in the long run. And so I think that we're going to start to see services inflation go the other way. Now let's go back to college education. And let's imagine a scenario, and I've got a middle schooler, but I think about when they're in college. I took some classes with 500 people in them, and you listen to the lecture for an hour, and you go back to your dorm and you study for 3 hours if you follow that guideline. But then you're learning on your own. Just imagine a world where you have an AI professor that follows your every move, answers every question, is looking at where your eyes are tracking, your body language, and really absolutely customizing the way you get taught any subject. I'm just going to predict that that's way more effective than the methodology used for most human learning right now. Perhaps you can get the equivalent of a top tier college education, certainly in the more technical fields, for, I don't know, what would that really cost to deliver? $1,000 or $2,000 a year? And so I think these are just a couple of examples that we've mentioned where services are going to deflate. We're all going to become way more effective. And, we can think of maybe there's a tax preparer, there's someone in financial services, and maybe they're better and can handle twice the volume. I mean, this just works in industry after industry after industry where what's being sold is a service, and that AI is going to make that person more effective. Just imagine having a co-pilot, if you will, a buddy, a best friend that just happens to have an IQ over 200 that's with you for every decision that you're going to make through your workday. There's going to be a lot more output, so economic growth, I would predict, but at far cheaper prices. And this has relevance to this pizza.net meme, if you will, that's out there and been out there for years, because this was invented for the movie, and then it became a reality. And it didn't mean that because this was now cheaper and more effective, that there were fewer people working and making pizzas. What it meant was pizzas got cheaper. Pizza joints proliferated all across the country, and way more pizzas got made as a partial result of technology being added. And we can go back through history at all sorts of big technological developments and see that they all led to a higher standard of living. They all led to economic growth. And in many cases, they led to more people working. And in the headline there, I refer to what's known as the Jevons paradox. And this relates to the steam engine. And when steam engines first were invented, it absolutely was a revolution. We could do things we could never do before. It launched the Industrial Revolution, but they still weren't all that efficient by modern standards, coal powered. And then there was a technological improvement where all of a sudden steam engines were much more efficient, much more effective, and needed far less coal. And if you approached that the way many people are approaching AI right now, you would think, well, demand for coal is going to drop. You just don't need nearly as much coal. But what happened is, because it made steam engines better, more productive, the demand for coal to fire steam engines actually increased. And in the AI revolution, we're the coal. we're the coal. You don't need as many humans for the same amount of output. First in services and later in goods, but I think services gets impacted immediately. That doesn't mean we need fewer humans. We might very well need way more humans. Either way, I think in the aggregate, it leads to economic growth and it leads to deflation. And so I think there is a direct linkage between the productivity increases we're going to see as a result of AI and deflation. I think it's going to be showing up in the data this year. I think the Federal Reserve is going to lower interest rates probably 2 to 3 times, certainly if the evidence does show up in year end. And I think this is just one of the things that the market has already begun to figure out, and why the yield curve now shows interest rates lower than we see for 1, 3, and 6 months. Is we're already aware that inflation is going to come down. We don't talk about it that way. We're all worried about inflation, but I think AI could be the driving factor here. So we'll finish up with talking about our toolbox and just remind you that, we can all invest in cash and fixed income and public equity, and hopefully we've made the case for how we do that well. Many people can do it themselves and other advisors can do it. We also have BIP hedged yield and BIP hedged equity, which use options, because we're pretty good at the math here, to give you a different type of return. Let's not forget about the private fixed income and the private equity. We've done deep dives on that in prior quarters and will in the future. But let's come back to this idea of inflation. Let's come back to this idea of artificial intelligence. Let's come back to this idea of volatility among individual stocks, and look at the 2 strategies that we dropped in at the top there. BIP short-term tactical is a way to invest in fixed income. We expect to do meaningfully better than if you're just in cash. The advantage of investing in treasuries is that we're not worried about FDIC limits, which you should be if you're invested in cash. And so it's been a great strategy for the last 3 years to give our clients a high return over and above the rate of inflation that does not have to worry about the risk issues, and is, again, I think, generally better than you could get from being in cash at a bank, even if you didn't have to worry about FDIC limits. The other strategy there, the BIP concentrated stock, is something that we don't always talk about too much, but this is not a good time to have too much in one stock. And you and your personal wealth advisor can help you figure out how much is too much, but we have a strategy using options to cut the volatility on a day-to-day basis in half. So if you've got too much in one stock, but you don't want to just sell it all and take the tax hits, the BIP concentrated stock strategy might be perfect for you as an addition to all the other tools in our toolkit that we're applying to your investment assets to give you the outcome that you need. And so, again, if we can cut the risk in half of having too much in one stock, but still be tax efficient about it, boy, that's the best solution that I'm aware of. And I only know of one other competitor that does that, and their minimum account size is in the millions, and their beginning fee rate is double what our fee is. So the fact that we can do that for our clients is, I think, a real triumph of our ability to build this out and benefit our clients in ways that we think other advisors might not be able to do. So let's just go ahead and wrap up. Again, the key themes are out there, and we're going to go over those every quarter. I think volatility among individual stocks and how the AI revolution is affecting that is the real key theme for this quarter. Let's remember that the economy is strong, and as artificial intelligence changes our world, we think it's going to raise the standard of living. We think it's going to lead to economic growth. We think it's going to lead to lower inflation. And whatever other things about AI scare us, there are at least 3 good things there to keep in mind. So we have a pretty big toolbox of tools to deal with whatever is unique to your personal situation. I'm sure many of you are not using every part of those, every one of those tools in the toolbox, every strategy that we have to offer. But don't be surprised if in your next financial planning review, your advisor doesn't look to more of those tools to help you.